open the doors for the webinar, let everybody in. So at 11:59. All right, so we'll get everybody filed in. We've got a lot of people registered, so we'll get everybody filed in, and then we're going to get to some introductions here, so everybody knows who's here besides me and Tony. And we always like to put a shout out to Tony for helping me do this. None of this is possible without her helping me out with my occasional last minute requests that I again just did to her. So thank you very much, Tony, for all of your help with all of this. So let's see here. Got the doors open, and we're going to get into thanking our sponsor today, which is Libby Popovic. And Libby is actually her being here has enabled you all to eat. So then again, that's you who have taken advantage. So if you're looking for a good real estate attorney, let me tell you about Libby. She actually focuses on transactional matters, including residential and commercial. I didn't know you did commercial. That's great. Yeah. Estate planning, business formation, and dissolution of business, along with contract disputes and trial work. That's really good, including commercial and complex litigation. Libby is a certified real estate instructor, licensed real estate broker in Indiana and Illinois, as well as licensed. You're a licensed loan originator? No kidding.
I am. I don't use it often. Some of it.
There you go. She's also taught numerous continuing education classes to broker managers and other real estate agents in Illinois on topics ranging from landlord-tenant disputes, foreclosures, tax appeals, contract negotiation, lead generation, and short sales. So Libby, I wanted to thank you very much for helping us provide the lunches. And if you wanted to tell everybody, give everybody a quick little commercial on you and how you can help these guys.
Absolutely. So thank you for inviting me to this, Rich. It's always a pleasure working with you and your team. And this one I especially wanted to do because it's something that we've been seeing a lot of and continue to see it with the appraisal gaps and the escalation clauses. So I actually wanted to be a part of this, since I'm going to also be doing a small little presentation on this 2 weeks from now. Those of you that don't know me, my name is Libby Popovich. I'm the managing partner at Popovich Law. And as Rich said, we primarily focus on transactional matters, mostly residential, some commercial, estate planning, and business organization. So I've got 3 offices. My main hub is in Tinley Park. That's where my staff is at. We also have an office in Berwyn and one in Chicago, and those are by appointment only. Some of you may have seen me do some of these lunch and learns and presentations. It's one of the things I love doing. I love working with new agents, existing agents, because it's really a team effort with everyone. And there's always things that are changing. I started doing this when the market had crashed. So I did a ton of short sales and foreclosure defense, not even knowing what the regular real estate market looks like. So then we had a nice upswing, and it's been amazing. Last 2 years has been super busy and blessedly slow for all of us. And now things are a little different. So we're seeing some things we haven't seen before. And I think it helps when we're all working together and understand the process and how quickly these things change. So if you guys ever have any questions, feel free to contact me. I think my information is up there. Is my information up there? If not, I'll put it in the chat.
Yeah, she's got it. Tony actually added your phone number and your email in there. So
fabulous.
So Libby, you got to know, Tony's efficient. That's for sure.
She is awesome. Yes. Thank you, Tony. She is great. You've got a great team, Rich.
Thanks. I appreciate that a ton. So speaking of my team also includes Sandee Lutz, who is our Midwest renovation expert. There's Sandee, and she's amazing. So we have a pretty unique way that we handle renovation here, and we'll get into that a little bit later. But she's been in the mortgage lending business for 30 years and been doing renovation. How long have you been doing renovation, Sandee?
Exclusively for the last 20.
For the last 20. Also made Scotsman's Guide, or one of the top originators this year. First time. Congratulations on that.
Thank you.
So very, very nice. And also coming to us from Michigan. So you're just outside of Detroit, right?
Yep, in the suburbs, around the east side. If anybody's from the old Michigan stomping grounds, northern east side of Detroit.
Don't you guys always ask each other where you're at on the mitt?
Yeah.
So.
Yep.
So where are you at on the mitt? So the
Down in
mitt being
there.
the shape, you're right there on the mitt. There you go.
Yep.
The mitt being the shape of Michigan.
Yep.
So that's good. All right. And our last presenter today is going to be Tim Edwards, and was recently promoted to sales manager of Magic for Illinois and Wisconsin. He has broad experience in his 33-year career in mortgage banking and structured finance. He's held positions in sales, marketing, loan underwriting, servicing, risk management, capital markets with MGIC, United Guarantee, Nation Star, and Opus CME or CMC. Sorry about that, Tim. Graduate of the University of Wisconsin Business School, go Badgers, with a major in finance and investment banking. Has 2 adult daughters and resides currently in Whitefish Bay, Wisconsin. Is that where you're sitting right now, Tim?
Yes, up in the attic.
There you go. You're away from his wife Margie and their dogs. So Jack and Coco. That's good. That's good. All right. So that's the bios on these guys. We're gonna get into the content. It seems like the room's filling up. So our content, guys, it's interesting. CoreLogic today just released their report that talked about property appreciation still year over year. Now, granted, this is April, we're in June, so it's a little dated material, but still year over year appreciation up 20.9%. And what was more important part of it was that 70% of the homes sold over list. So you guys are here to learn about how to make an appraisal gap offer when maybe your client doesn't have that extra money over and above what they were planning to put down. So why do we need to do that? Because even though things have slowed a little bit, I'm still hearing stories of 5, 10, 15, 20 offers out there and people having to offer more, and it's created this appraisal gap situation. So we're going to show you today some loan programs that can be used to help your clients bridge that gap without actually coming out of pocket with any money. We are going to have open in the chat box. You guys get to ask questions as you go. There better be a lot of questions because this stuff is super, super high level. So I expect you guys to have a lot of questions. And at this point, we're going to now address appraisal gap offers for conventional loans. And I turn it over to Tim Edwards with MGIC.
I'm unmuted. Can you hear me?
Yes.
Going to share my screen. Let me get there.
We got it. We can see it, Tim.
Okay. Let me get rid of all the happy faces. Okay.
Yeah.
Welcome. Thanks for inviting me along. Overcoming the low appraisal, hot topic today. Actually, really the last few months, and doesn't seem to be dissipating. And this is going to go over a concept using the mortgage insurance product to address the issue when it arises. So just got about, I don't know, maybe 10, 15 slides here. Shouldn't take too long, but I'll walk you through it all. Well, legal jargon, we don't need to get into that. But I just want to point something out. This is actually my second visit to this call with Rich, speaking to the real estate community. And last time out was promoting the use of mortgage insurance in general and talking about why it's needed, when it's needed, but also why people might use it other than because they have to. And one of those, if you look at the screen, the lower right-hand corner, one of the ones we talked about last time was overcoming a low appraisal with mortgage insurance. So that's a choice to use our product versus you got to use it. And it just interesting that we're drilling down deeper now into one of the topics we talked about last time. So nice to be back. Hopefully not too redundant for anybody because we're going to go into a little more detail now.
Yeah, and I think, hey, Tim, I think originally when we approached it, it was just the concept around MI. You know, we're kind of looking at this today like, hey, my buyer's approved conventionally, but in order to compete, he's going to have to offer more. So, I mean, I think what you have to offer is really good.
Yeah. So really looking around, as Rich was describing, what you're hearing in these reports and in the press, we still have historic lows in the available housing inventory. Highly competitive bidding. Don't need to tell you all that. You're experiencing it. That's causing a lot of upward pressure on prices. That's good news. And that's even continuing in spite of the recent rise in interest rates. And rates really have gone up a lot. Things are slowing down, but the competitive bidding is still happening, and prices are still going up. And what we're talking about here is prices going up so fast that it's getting ahead of the market, or getting ahead of comparables, if you will. So I'm going to walk you through an example of how this might work, and feel free to ask questions as we go along. So just take a sample home purchase for our discussion today. Say you're listing a property at $379,500. Your home buyer goes out and makes an offer at $400,000 because of the competitive environment. At $400,000 at 20% down, you're going to look at doing a loan amount of $320,000. That's a kind of vanilla 20% down conventional loan based off of the accepted offer, hoping that in a couple of weeks the appraisal is going to come through. And when it doesn't, it's a problem. So in this case, oh no, appraisal's low. It comes in at 380. It's pretty close to a real life situation. I think the listing price reflects the expertise of the real estate community. They know where values are, but they're running up, they're getting ahead of the market, and people are overbidding just because of the competitive nature. So situation changes. Sales price was $400,000. With that down payment, we said it was going to be a $320,000 loan amount. When the appraisal comes in at $380,000, the dynamics change. If you stick with the thinking of 20% down, that's going to make for a loan amount of $304,000, but the borrower still has to pay up $400,000 for the property. So they're going to need an additional down payment of $16,000, generally speaking. So when it does come in low, the home buyer's got a couple options. They can go back to try to renegotiate with the seller.
Hey, Tim, before you go on, what's the success rate of that, Libby? Going back to the seller and renegotiating.
Let me unmute myself. It really depends on how low the appraisal is. So on the conventional ones, if the appraisal comes in a lot lower, what we're seeing is if the seller, certainly last summer, if the seller thinks that they're going to be able to get more, I've had sellers instruct me to, deny it and move on. Lately, last couple of months, where we've had it come in, usually around, if it's like 15 to 20 less, people have been willing to kind of work with it, where I've had a couple of sellers that have gone down a little and the buyers have gone up a little. So I'm seeing a little bit of a shift in that right now.
So, and then the other issue though at hand is if we put in that appraisal gap to the 400, then we don't have option number one that Tim's posting here is not an option. So. Right.
You've already agreed to it up front.
There you go. Go ahead, Tim.
Yeah, so you can attempt to renegotiate. It's an option, right? It depends how good you are. So that's one. Two is the one where we were facing in the example, pay the difference out of pocket. That's the plus 16,000 in our scenario, or walk away. And that's probably as difficult as number one, depending on if there was a financing contingency and some other things in there. So,
yeah, if there was an appraisal gap to 400, you're not walking away.
Yeah. So what do you do? That's really, we'll call that conventional wisdom. What we're here to tell you today is the unconventional wisdom. First, don't panic. There are solutions. Second, we're going to recommend you don't change the loan amount. Instead of going at 304, go out at 320, but you use private mortgage insurance. Of course, I have a biased opinion there, but we're going to show you why that makes sense. And it's, you're going to question when, wait a minute, I just got kicked in the teeth with a low appraisal, and now you're saying incur the cost of mortgage insurance. Yes, we are saying that. And the reason for that is the phenomenon in loan level pricing from Fannie Mae and Freddie Mac that helps offset the cost of the insurance. Now, we're not here today to delve too deep into that, but I'm going to show you how it works. And then we'll look at some loan examples of what you may do given the low appraisal. As Fannie and Freddie buy loans from cross country and others, there's pricing impacts based on different risk characteristics. But when you just go off of LTV, you can see how the price goes up as the LTV goes up. And that shouldn't be a surprise. So just looking at this credit score table, you got 740 and then some ranges below it. But just look at the line of greater than 740. And as you move to the right, you'll see LTV buckets. And then within that, you see a price for that LTV bucket. So at a credit score greater than 740, when it's a 60 LTV, 0. You move up to 60 to 70, lender's paying a quarter for that. 70 to 75, it's a quarter. 75 to 80, it's a half. Look what happens though when you go over 80 into the 80 to 85 bucket.
And I want to point something out on here, Tim, because really what we want to focus in at the 75 to 80 LTV being loan to value. So on the 75 to 80 loan to value, basically what this chart's saying is that Fannie Mae would like to charge, like us, the lender, we have to charge another 0.5 point either to the borrower in a true cost to them, or we're raising the rate about 0.125% traditionally to absorb that 0.5 point. Now, if you go on that, staying on the 740 line for the 80 to 85 LTV, what Tim's pointing out is that drops down to only 0.25 point that I would have to charge the borrower and or bury in the interest rate. So technically, there is some interest rate savings that's created by the higher loan to value. Go ahead, Tim. I just want to make sure we got, that's very simple. So I don't like, acronyms. Sometimes we just want to explain everything. So.
Thank you. And this is lending. I'm not a lender, so I'm glad you addressed it. I can just see the difference. When you move from 80 to 85, your price dropped in half, but technically your risk went up. Reason for that is the present mortgage insurance. And because of our coverage, Fannie Mae, Freddie Mac, their view of the world is my 85 just became a 70. So that price drops. And this dynamic here is what we're going to use to help pay for mortgage insurance and mute the effect of the low appraisal. So by raising LTV, incurring the cost of mortgage insurance, you get a little bit back in the price of the loan. That helps mute the effect. So that's.
And one last thing on that, Tim, just for, and thank you for letting me interrupt, by the way. One last thing on that, there's the reason that, so what Fannie Mae and Freddie Mac are saying is that loan at 80 to 85% is less risky than the one at 80%. Now, why would it be less risky? Because, on the surface to all of us people, hey, the client's actually putting down, let's say 15%, 16%, not 20. Why is it less risky? Well, it's less risky because there's not a company like MGIC there to insure the lender against default. So once the client hits 80%, that lender is exposed to 80%. And Tim, you're not covering this in a slide down the road, are you?
No, this is where we.
Okay, good. All right, good. So once the lender hits 8, or once the down payment hits 20%, there is no PMI. But a loan to value over 80% creates private mortgage insurance, and private mortgage insurance insures Fannie Mae and Freddie Mac to 72% loan to value. So ultimately, a loan with 20% down is more risky than one with PMI, because the exposure or the risk is 80 cents in the dollar if they're at 20% versus 72 cents in the dollar. Go ahead, Tim.
Yeah, so this is a quirk. Well, it's actually very logical, but when you just look at it on the surface, it's a quirk in pricing, and that risk appears to be going up as you move up the loan to value scale, but price just went down. Now, it just happens to pair well with the problem we just incurred, and that is the low appraisal. And yeah, low appraisal at 60, a different case. We're really talking about loans on the margin here, but there's a lot of loans where the target LTV is 80%, to quite honestly, to avoid mortgage insurance. But again, taking advantage of a seemingly quirky phenomenon in loan pricing, although there's logic underneath it, but it does help with our problem. So this low appraisal comes in. What are your options? Well, I've laid out a number of them here using mortgage insurance, and you can kind of see how all the dials turn and all the dynamics change in the loan. The gray column on the left, the 80 LTV as originally expected, that was the proposed transaction, 20% down, 320 loan amount. I think we're using a 5% interest rate here. So principal and interest is $1,718. And that's principal, interest, and mortgage insurance, but there's no MI, so that's zero. That's what you wanted to do. If you go with conventional thinking, column 2, you're gonna do an LTV of 80 off the 380, the lower of sales price or appraised value.
So, and let's preface this too, because what column 2 represents right now is we made a $400,000 offer with an appraisal gap guarantee that we would make the difference up, which creates the numbers that Tim's about to review in column 2.
Yep. So bottom line is borrowers got to come up with 16,000 more closing to get to the closing table. They're instead of financing 320, they're financing 304, but they're paying the seller 400 still. It does result in a slightly smaller monthly P&I because you got a smaller loan, but you come into the table with 16 grand. That is an option, and it might work for somebody.
They're not here for that option, Tim.
And I'm not here for that option either. I'm telling you that the columns 3, 4, 5 to the right are the ones you want to do. And so different options here. The next 3 columns, the last 3 columns involve keeping your loan amount initially at 320, paying mortgage insurance. And then what this really is paying for it different ways. So column 1 is a single premium paid out of pocket. Not many people do that. But when our premium is $1,312, and it's a one-time single premium, no monthly, no renewals, insurance for the life of the loan's covered there, we're charging $1,300, but the give back in the loan pricing, that quarter point we saw in the LLPA charts, given these loan amounts, that's going to create a credit of $800. So the net is out of pocket $512, our premium less the give back from LLPA pricing. So they're going to incur an additional $512 in closing costs, same loan amount, same interest rate. So payment stays the same, $1,718 for P&I. Option 1. Option 2.
Hang on, hey Tim, let me stop there for one quick second. I want to cover that again. So the original, I believe column 1, there's probably a little bit of a typo. We should have probably had 400,000 on the top, because 20% of 400,000 is 80, not, you know what I mean? So that should have probably tried to reflect that, but that's okay. What I really want to focus on is this single premium. Basically what we're saying is that our client went into this thinking, hey, I'm going to come in with 20% down to 380, but they got put in a little bit of a box because, hey, we're going to have to be more competitive. We're going to have to go to 400 to get the house. Cool. How do I do it if I don't have the $16,000? You immediately go to column number 3, which talks about buying out the mortgage insurance. And the best part about it is that the bottom line payment is exactly the same as it would have been had they just offered 380. But we know, especially you agents out there know, they weren't getting the house at 380. It was going for 4 because there was 4 other people behind willing to do that. Well, your client wanted 2 things when they came to us and said, hey, approve me with 20% down. They wanted no mortgage insurance, and they're getting the exact same payment and for the additional cost of $500, not $16,000. So I want to make sure I point that out. I think that's really, really important. So go ahead, Tim, if you want to hit the next column.
Sure. And actually, thank you for pointing out the problem in column 1. I didn't see that. The intention was a $400,000.
So it's okay.
Yeah. So option 1, pay it out of pocket. There's $512. Option 2, another single premium, still $1,312, but rather than pay it out of pocket, in some cases you can finance it into the loan amount. So your $320,000 loan becomes $321,312. We're just adding in the insurance premium, similar to what you might do on an FHA loan. You still get the credit back because you're you have MI coverage and the loan's insured down below 80 to the 70 level. So actually it reduces your closing costs by $500 in this case. And you do got to pay for the mortgage insurance, but it's in the P&I payment now. So our 1718 off a $320,000 loan amount now becomes $1,725 off the slightly larger loan amount, $321,312, which has the MI premium in it. So there's no separate line item for mortgage insurance. It's a slightly higher principal and interest payment, but you are getting a credit at closing for $800 to offset the other costs you're paying to do the transaction.
There you go. There you go. So quick thing on that. We do have a couple questions coming in and I'm going to take a stab. I believe I got this. Yanila asked, hey, this is great information. Will this work on FHA? That's why you guys are here. We're going to talk about FHA. However, FHA does offer an option to do this. It's significantly different. That's why we have Sandee here. And we don't like to talk about FHA too much when Tim's speaking because it's a dirty word. So it takes business away from him. So Yanila, we will get back to that. Paul Bednar, Paul asked, seems like MI, excuse me, seems like MI can reduce the cost to a borrower if they don't put down 20%, even if the appraisal is fine. Is that correct? I'll let you answer that, Tim.
Yeah, actually, this is a concept we've been marketing. We even have a little brochure called 15 is greater than 20. And we are encouraging people, hey, when you're at 80 LTV, move to 82, 83, put less down, get the dynamics of the payback, and you're just doing your loan differently. So yeah, we do have some loan officers that do that as a course of business.
Yep.
And they're taking advantage of that same quirk, but they're not starting with the problem. They're just seeing it as an opportunity and working the same thing.
An opportunity to be unique, which is good. And Paul wants you to send me some of those brochures so I can get them to him.
Right. Okay. No
All right. So we got our questions covered. I think we got column 4 done. Let's move on to column 5.
And just the one last thing on the 15 greater than 20 concept. The idea is freeing up your money. And if I take you right back to the very beginning, that was one of the reasons to strategically use mortgage insurance, putting less down toward a payment or maintaining flexibility on your budget. It's freeing up money rather than, getting every last nickel into the deal to get to 20%. You back off, maybe you free up $2,000, $4,000, $5,000, $10,000 for the moving into the new home, buying curtains, appliances, all the things you might need the money for. So yeah, great question. And actually you get a role in our marketing department for that. So
there you go. Yeah. The other thing,
go ahead.
hey, Tim, the other thing about that too is, so we do teach a class to all of our clients we close loans for that. Basically it's called, we got you into debt, now let's get you out. And in that class, so everybody that closed with us the previous month, they'll get the invitation. In that class, one of the things we talk about is setting up an emergency account. And it's really our foundation on that class, because like you said, a lot of people plow through their money as part of this process. And now they've got this house and maybe some other bills that might be coming down the road. I think MI is a really good way to help them fund that emergency account, give them the safety and comfort of actually having some money in the bank versus putting every last dime into the transaction. So
I agree. So last example, far right column, borrower paid monthly MI. This actually is how most mortgage insurance is paid for. Single premiums generally have some sticker shock attached to them because it's all the premium at once. And for whatever reason, $29 a month doesn't feel as bad as $1,300 up front. And it just depends on who you are, what your situation is. But, we do single premiums a little less than 10% of the time. The rest is generally monthly mortgage insurance. So in this case, same benefit in pricing. You've moved from 80, to an 82, 83 LTV, 84 in this case, incurring the cost of mortgage insurance. Our monthly premium for this loan, this risk, this LTV is $29 a month. So that does raise your monthly payment from the 1,718 to 1,747. That's P&I plus mortgage insurance, or PITI, some of it. But you're still getting the back of $800 from the loan pricing. That helps pay for other costs and expenses at closing. But you're not, in either case, or in all three of these cases, you're not coming up with the additional down payment of $16,000. So we're fans of all three. We think this is a great play in times of need as a low appraisal, but also as just normal course of business, incurring the cost of mortgage insurance to solve a problem in this case.
So I got a couple questions and a statement, and we got a couple questions that hit the chat. Go back to that previous screen if you don't mind. Thank you. So first of all, the 1312 divided by 29, your break even's about 45 months or just short of 4 years. So, just to give you an idea, after the 46th payment, the $29 a month becomes more expensive. So that's more expensive than paying the single premium. So Lenice asked a question, said, so should clients come to the table already having MI? And I don't know exactly if she means that, is it better to, I don't exactly know. I want to answer the question two different ways. Number one, sure, you could implement mortgage insurance in your loan if you want to actually have, start your home purchase out with maybe keeping a little back into a nest egg or safety or security account. That's one option. Could you also do something creative like this if the client was coming to me and said, hey, I have 10% down, I want to go conventional. Now we under appraise. Could we approve them at 97 LTV, 95 LTV in a situation, still allowing them to make an appraisal gap offer or make an appraisal gap offer, but maybe we don't have as much to play with there. It is possible to slide the loan to value up. In some cases up to 97, in most cases to 95 LTV. So again, I'm not sure where Lenice was going with that, but I wanted to answer what I think could have been where she was going. The other question that I had from Yanila, you got to let me know if I said that right, by the way. Yes, the upfront, she asks, so if the upfront single premium is paid, there will be no monthly mortgage insurance, Tim?
Yeah, if it's paid up front, the 1312, it's a single premium. By definition, that's it. That's all that's ever
all
paid.
done. All done. And I nailed the name, so I love it. All right, good deal. All right, I think we're done with questions on this slide. Go ahead, Tim.
Hey, I'm going to clarify two things for you on those questions. The break even. Yeah, in this case, 1312 divided by 29 is 45 months. That means from where I sit, knowing our pricing guys, this changes around, and our target is generally 4.5 years or 54 months. So what does this means today on this example? Single premiums are a better deal on a relative basis to expected lifetime collection of the $29 per month. There are days when it goes the opposite, where say that's 36 a month or something. I don't know what that equates to, but 13.
That's good. So it's on sale ultimately right now as
Pricing moves around. Today, this makes a single look better over time. There are days when it doesn't. It just moves around. But rule of thumb, 4.5 years. If it's less than 4.5 years, yeah, there's a blue light special going on at single premium. So that's one. The other one on the moving 90 to 95, the concept works, but doesn't, in that you get a low appraisal, your 90 becomes a 95. We can still do that loan, but what you're going to miss is the credit for the LLPA, because back here, when you move from a 90 to a 95, you're going, well, look, in this case, 740, the 250 maintains. So you're not getting a credit, but you're not going up in price. Going to 97 though, you go from a quarter up to 75.
yeah. So there could be some changes, maybe possibly in the rate or possibly in the fees to do that at certain loan to values. So yeah.
Do you get the big credit? No. Is there an ability to do that loan? Yeah. Cross country and MGIC doing 95s and 97s all the time. So you're not going to get the pickup of crossing the 80 LTV because you've already crossed it. So
Cool.
I just wanted to be clear on that.
No worries.
So yeah, those are our examples. This is how our product may help you in times of need or just times of opportunity. Yeah, in this case, we kept the loan amount the same, the LTV went up, and we kept the payment the same, or we reduced closing cost. It was, one or the other, given there was going to be pain, period, because the appraisal came in low. So couple reminders of why this worked or why it was good for the transaction. For the borrower, it reduced the need to pay out of pocket, keeping the payment the same or close. And bottom line, it helps save the transaction. That same applies to you, to the real estate community. This helps you maintain a transaction in the face of a surprise. And, it is a surprise when it happens. And bottom line is, giving advice like this, it makes you look like more of an expert to your home buyers. You're coming up with a creative solution to a problem or just a good idea in general. So wanted to mention those. Rich, that was it. Just wanted to touch on that. And I guess we can open it up to questions, but it sounds like we've already gotten a bunch of them. So
Yeah, we got a bunch here. We're going to let you release the screen and let Sandee get set up for her presentation. And then I'm going to, as we're doing that, wanted to share with you guys. So we've covered the conventional way to do this with the appraisal gap. Very, very, very important. Meet with your loan officer and make sure you have a discussion with them to make sure two things. Number one, make sure the client's going to qualify at the higher LTV. In most cases, Fannie and Freddie are okay with the higher LTV because, as we've mentioned, they're at less risk. But you definitely want to talk to your loan officer and say, hey, this is the game plan I have moving forward. How is it going to work? Are we going to be okay if we offer this and slide or transition into this offer? That's also important to do when we start talking about this FHA appraisal gap offer, which I know is one of the reasons a lot of people tuned in. I'm super excited to present this. It's a concept, quite honestly, most lenders aren't even aware of. So Sandee is our Midwest renovation expert. We're super excited to have this. We put this together, and I'm going to turn this over to Sandee, who's given us our screen to work with here.
Hey, everybody. Okay, so we want to talk about FHA coupled with FHA 203K. That's the basis of what we're going to talk about here. So in this example, our client put in an offer at 330. They have 3.5%.
Hey, Sandee.
Yeah.
The way we did this, I want to, and I kind of have to preface this. Excuse me, I apologize, guys. I have a frog. 203K allows us to stretch, but we're going to show you how we get there. So I don't know that I was going to jump into that, but I mean, it's okay. I think because a lot of people have a lot of preconceived notions about 203K, you know, about the work that's required, all that other stuff. So I'm going to ask you guys for a little patience as Sandee goes through and explains and answers your questions about why a 203K would be the way to do this. Go ahead.
So yeah, you know what, Rich, let me back up. There is so much misconceptions out there about 203K for sure. There are two programs in the family. I think a lot of people hear there's a minimum of $5,000 of repairs, or there's a maximum of $35,000 worth of repairs. That's the difference between the two products in the family, the limited version and the full-blown version. So the limited version is for small things. I mean, I've done a 203K loan for a $900 plumbing repair, right? We couldn't get the seller to do it. We couldn't close on the loan the way that it was. It was violating FHA minimum property standards.
Hey,
so we put
Sandee.
together a 203K for that.
Sandee, I don't mean to interrupt, but I'm getting some feedback in the chat that your volume is a little bit on the low side.
Yeah, I'm sorry. I don't know what's going on. I'm going to try to turn it up. I don't know what else to do at this point.
You
I
might
just
have
don't
to
want
use,
to blast anybody out of here. How's that? Is that better?
doesn't seem that you might just have to raise your voice as you're doing this. So put your booming speaker voice. I'm still getting no's from the crowd. So do you have children? However, you have children, right?
I do, but they're grown. I don't have to yell at them anymore.
You got to raise your voice for everybody,
Okay.
unfortunately.
Okay, so I'll try to talk loudly. So what I was talking about was the difference between the streamline or the limited version of the 203K and the standard. So just know that your client can have a very small repair and still utilize the FHA 203K. That's the point I was trying to make. So let's go back to this example. So the client 330 sale price, 3.5% down, or 1150. List price was 300. That's where we think the appraisal is going to land, right? So we're kind of going into this with the idea that we may have a short appraisal.
Well, we pre-approved them to 330. That's the important part. Go ahead.
Right. There is something that we will do on our side to make sure that the 330 would work. So the offer price is 330. The home appraises for 300. Now what? Back to the board, back to the original options, price reduction, go back to the seller, walk away. If we flip this to a 203K, we have a third option. 203K has no minimum. We walked through that a little bit. So we could do a simple repair to the house. We could put in a new hot water heater. Maybe the client would like new appliances. We can do something very small and still make it a 203K loan. So the FHA 203K loan has a feature that you can go to 110% of the after improved value. They still have to have their skin in the game, you guys. So this math equation here is showing you what you can do. It's 110%. Excuse me, let me back up. It's 96.5% of 110%. You still have to have your 3.5% down. So that makes our loan amount now $318,450 on a $300,000 appraisal.
Hey, Sandee, let me back up real quick because I just kind of want to walk through some math a little bit slower again because you and I are mortgage and numbers people, so I want to kind of walk through it conceptually. So if we have a loan that's a 203K and that $300,000 there, it represents the appraised price. So because it's 203K, that's really not the value that we'll use on the 203K. Excuse me, they'll allow us to add 10% or basically multiply the appraised value at 110%. So now we're actually using an appraised value of 330, and then we just multiply the standard FHA 96.5, and the amount that we could lend them is still 318, even though it appraised at 300. So I want to make sure I covered that a little slower. I want to make sure we covered how the math works on that. If you guys have questions, please hit the chat box. Again, this is pretty complicated as it were. So, all right, good deal. So Marianne asked the question for the 203K, how long does it usually take in the house? And Sandy, I would say for a little repair like we're talking, under 45 days.
Yeah, so it's all going to depend on how quickly they can get the bid to me, because we have to have the repair bid. We do have to give that back to the appraiser. And the smaller jobs are the ones that move quicker, for sure. You know, when we're gutting the entire house and adding another level or doing whatever, those take a lot longer. Yes, but you have to have a consultant and you need a more established contractor. I mean, for something like this, they could even go to Lowe's or Home Depot and get a quote from them. We would use that for our contractor, which is a national company, doesn't go through a platform for validating or anything. It's a very simple way to do a 203K loan.
Perfect. Go ahead, Sandy. And everybody kind of got their questions answered. And I think the explanation was good too. So we're good.
Good. Okay, so like we said, any repair, $350 for windows, $800 for a hot water tank. We would add that cost. So $350 and $800, we would add approximately $1,150 to their loan. We're adding in the cost of the renovations. When you do a 203K loan, it is one big loan. We do increase their loan amount to cover the cost of the renovations. That's how you get the higher loan amount. So then we look at it this way. The 110% gets us.
Hey,
to
Sandy,
300.
Sandy, I got to go back 1 second. So in the example that we gave, and back, if you guys back up one slide for me, Sandy, perfect. In the example that we gave, so actually one more slide, if you don't mind. There you go. So in the example that we gave, in this particular example, our client is still coming up with the exact same amount of money that they thought they were going to come up with. In other words, they're still going to come up with whatever that is, $11,550. If we only appraise at $300,000, and even though a hot water tank, a new window, a couple of appliances, none of that's going to move the needle for the value. Value is still going to stay at 300,000. So in this particular example, if the client, let's just say they do $350 of windows, and by the way, there are renovation costs. There's a cost to do a renovation loan. We are very unique. We don't third party anything. So we keep everything in house. So we do that to keep the client's cost to a minimum, but these loans are a little labor intensive. The cost to do that loan is about $1,150. So if they're doing $350 in windows, $1,150 in actual costs, then, and we only got 300, even though we bid 330, the only extra amount of money over and above their down payment that they were already approved for at 330, we already knew they had it. The only extra amount of money out of pocket is $1,500 to cover the repair and the cost, because we couldn't include them necessarily in the loan and keep our loan to value correct. Now, I wanted to preface that, by the way, that's a lot better than coming out of pocket with $30,000, which is what the appraisal gap was. So again, any questions on that, let me know. The slide that Sandy's going to go into next talks about, well, hey, we thought it would appraise at 300 and it actually came in at 305. And by the way, that gives us a right to put in some of those costs I just covered. I'll let you cover the rest of that, Sandy.
Okay. Yeah. So 305 times 110 gets us to 335.5, which would be the value that we would use as the lender, multiplied by the 96.5. That represents the 3.5% down that the client has to put down. That equals our total loan amount, the 323,757. So then we're saying here, we'll put those costs of repairs in. If you look at the math, the cash down only went up by like $150.
And
which is amazing considering how short the appraisal was.
And here's the other thing, amazing considering how short the appraisal was, guys, and that if we're lending 96.5 off the 332,150, in other words, we're lending 320,524, it's underneath the maximum that I could have lent as long as I get that 305 appraisal. So if we get a little bit more, we can roll all this extra stuff in. The client doesn't even come out of pocket for that extra 1,500 in the example I gave in the previous slide. So
Right.
it is financed and done.
Right.
Let's see here. In addition to, can you do a 203K in addition to a seller credit? Yanila wants to know. Can you get
Yes.
seller credits?
Yeah, it's going to follow your standard FHA guides. So you could still have a 6% seller credit off the sale price, not
Yep.
off the after improved value, the sale price.
Yep.
Yeah, FHA 203K is a product in the family. It's not going to add a bunch of added requirements to you. Most people that qualify for an FHA loan are going to qualify for a 203K.
Perfect. Sandy's at it. Oh, that is our last slide. So that's our last
Yeah.
slide. So
Yeah, keeping it simple.
we tried to keep it really simple. So, and it is breaking it down the way we broke it down is pretty good. Again, I saw a couple things we'll probably change on these slides going forward. So, and I know Tim said Tim, you're going to make that change on yours too, right? Okay, good. All right, perfect. So since we have Sandee, who's our Midwest renovation expert, if anybody else has any questions about renovation, please ask them now. Otherwise, I'm going to jump to the last part, which is also going to help you guys on your offer. Sandee, can you give us our screen back?
Yep.
Okay, perfect. So let's see here. Whoops. Did I miss just that might not work with that? So Joni asked, did I miss a traditional FHA loan or does MI program not work with that? So the private mortgage insurance, or PMI, private means it's non-government. So that's only going to apply to conventional loans. So anything that Magic, MGIC, those companies would do would only be to a conventional loan. So I think I addressed that. Paul, with the 203K, only do you have a fee, but is the rate higher, and does a supervisor have to coordinate the work from approved contractors rather than me, the homeowner, doing it? So, Sandy, you want to tackle that one?
Sure. So the rates could be a little bit higher. Not always. It depends on pricing of the day, but typically it's not enough that it's going to deter the client, especially with the short appraisal. And then your second question, what you're talking about there is the 203K standard. That standard loan requires the use of a consultant. And he's not, the way that I like to tell people is he is their advocate. He is a help to the buyer. It is like a consumer trying to buy a house without a realtor. Honest to gosh, you guys have a function that you do. The consultant has a function that he does.
But Sandy, when we're talking about appliances, a window, a hot water
Not
tank,
required.
we're not bringing that person in there. So,
No, it would
okay.
just be the contractor and the homeowner, or, the national company, if that's the way they want it to go.
Okay, perfect. And I'm going to jump into my screen share because we want to make sure we're finished by 1 o'clock. And we've got this little guy. We're going to do this. I've got to actually change this. I got to move this. Let's see here. That's what I want. Okay. So that's, you guys can see our peace of mind pledge. Somebody give me confirmation on my panel. Okay, good. Thank you. All right, good. And I just got to open up the chat a little bit so I can make sure I can see that as it's coming in. All right. So this is something new that Cross Country is going to be doing, specifically the Kimball team. So if you're working with another loan officer from Cross Country, they may not do this. This is something we do because we feel confident in the work that we do. So what I wanted to show you guys is we are going to have a pledge going forward with almost any loan, I should say. Most of our loans that we put through our fast track program. Our fast track program is our full mortgage underwrite of the loan. And we can do all kinds of loans through the fast track. All kinds of loans can go through their manual underwrite loans, even some non-agency, non-QM. They can all go through the fast track, but we're only going to offer this pledge for our conventional FHA and VA. And what our pledge is this, and it's going to be in writing when you guys make an offer. We're going to basically say, look, we pledge that we're closing this loan and we're going to put our money where our mouth is. It's $5,000 of my money that we're going to put on the line that basically says two things. Number one, If we don't close this loan because of something we did, we're going to reimburse the buyer for his home inspection and his appraisal up to $1,000. And then we're going to take care of the seller up to $4,000 if we don't close the loan because of something we missed. We should have caught through the fast track process. Now, couple things real quick. Unfortunately, if the client loses his job the day before he closes, there's nothing I can do about that. None of this stuff applies. I'm talking about errors that we would make. I'm going to tell you, if I fast track approve somebody, they're as good as cash, subject to title and appraisal. So the other thing that we're going to do, it's for purchases only. It has to be fast track approved. And we talked about it, conventional, FHA, VA. We are excluding a couple things. I have to exclude the bond program. They can be a little bit dicey, unfortunately, on the bonds. And we are excluding condos because condos can be a little bit rough and just they can be a little bit rough for the condo approval. We have a great condo desk here. We do spot approvals on condos, but this is something that we want to be able to offer you guys. You know, this whole presentation was about what else can we do to help the buyer get his or hers or their offer approved. Appraisal gap is one thing, but this is us putting our money where our mouth is and basically saying, hey, look, we're going to make the pledge that this deal is going to close because we did the work and we did the due diligence. So you guys are the first to hear it, and I'm kind of happy to introduce it. Just kind of looking through some of the questions. Okay, good. So this is something that we're going to do. We're happy to have it. And I don't think I have another slide of this other than our peace of mind. If you're working with us in our team, certainly you'll have peace of mind working with Libby. She's amazing. You're going to have peace of mind working with us on a renovation. The best thing about Cross Country's renovation is I don't take care of the contractors or do any of that stuff with the disbursements. That's Sandee and her team. Sandee doesn't do any other kind of mortgage. She does these 203Ks and she's damn good at it. And then we've got mortgage insurance, certainly with MGIC. They're a big partner of ours. They definitely give us the flexibility to let your buyer keep more money in the bank and maybe compete in a situation where they didn't have the money to compete before. So with that, so Joni had asked how it's going to be communicated. We will have some paper, we'll have some marketing materials that you'll be able to put with your fast track that talks about it. And then we will incorporate it in our videos. We do a fast track, a 1-minute fast track video where you can present that video to the listing agent and the seller, basically telling them that client's already done their due diligence. We've cleared everything subject to title and appraisal. We can close in 14 days or less. And we've got a $5,000 guarantee that this file is going to close. So we will have paperwork on that. Tony, I don't know if she's here, but Tony can tell me where we're at on she's got some of that stuff up through the marketing department, and I haven't had an opportunity to check with her on that. So that is what I've got for you guys. We are coming up on 1 o'clock. And if you've got any questions specifically, certainly hit the chat. Tony put a little note in the chat that our marketing for that, Joni, is almost available. And I would think, I don't know, hopefully that's not corporate almost available, because that means next week. If it's on us almost available, should be by the end of the week. But you guys are the first to hear it. And again, we just want you guys, when you're working with somebody, we want to be an advocate for your client. We don't want you having to go offer. And we know what happens. Our clients get fatigued, and maybe sometimes they start blaming it on you when it wasn't your fault. We know if we put our money where our mouth is at, they have a better chance of getting approved for the first or second home and not 7 or 8 down the road. So Tony tells me by the end of the week that we'll be able to put this on top of any of the loans that we fast track that qualify for the program. If you guys have any other questions, please let me know. And again, we thank you guys all for being here. And we do have one more presentation this month. It is going to be on property taxes. I am going to have real estate attorney Ryan Shafkus, who specializes in property tax appeals. He's going to be with us Saturday, June 25th from 9 to 10. invite your customers, come to the class. He's going to show everybody how to, I got a puppy in the background. Is that you, Libby? So somebody's
No,
got a
not
puppy
me.
bark. Somebody's got a puppy barking in
I'm
the
in the
background.
office.
So anyway, we're going to show you guys basically in the June 25th class, we're going to show you how to read your tax bill. Ryan's also a great, if you're looking at a property with a client and they are wigging out about the high taxes on it and you think they're wrong, you can call Ryan and say, hey, can you do a quick analysis and tell me if these taxes can be adjusted? You want to use him as an asset to help your clients, maybe help you get one more deal. So that's Ryan Shafkus. Tony's put the link in the chat where you guys can sign up for that. And of course, we'll be promoting that for the next few weeks. Thank you guys for attending. Thank you very much, Tim, for the time you put into it. Thank you, Sandee. Thank you, Libby, for feeding our people. And
You're welcome.
again, I can't do any of this without Tony. So thank you very much, Tony. And thank you to the puppy barking in the background. So,
Thanks, Rich.
all right, you guys have a great one.
Bye, everyone.